and welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is July 29th, 2020. Well, we've seen this huge, well, some might call it a huge increase in precious metals prices. We're seeing gold currently at record prices, blew through 1900. Now it's in the mid 1900s and record closes in gold. Silver, as always, is the laggard right around that $26 mark. It hit night before last, and it's been dragging a little bit. But somebody who actually called this and called it in March when markets were kind of in flux, shall we say, to say the least, is our good friend Lobo Tigre. And you find Lobo on independentspeculator.com. Been meaning to have you on the show for a while, Lobo. Welcome to FSN. Oh, and if you have any questions for Lobo, myself, and your opinion where gold prices are going, don't forget we're having a contest on, it's going to end, it'll start in the next day or two. It will end on August 13th, which will mark the 49th anniversary of when Nixon closed the gold window. And we're still living through the unintended or perhaps the intended consequences of that momentous event even now. So, Lobo, it's great to have you on the show. And, hey, you kind of called this. You weren't talking so much on gold because, look, the increase in silver, it hit 1180 in the March debacle there. And, you know, then to hit 26.25 is really a heavy resistance point. What was the tip off to you?
I go a couple of things. First, thank you for having me on the show. This is a first for us, though we've known each other for years, first time. And we probably should say for the viewers out there that they may remember me by the pen name I used when writing for KC Research for almost 14 years, which was Louis James. So if you're saying, isn't that Louis James? Yes.
I like Lobo better, honestly. It's more authentic, and it's just a cool name.
You know, Doug Casey outed me. He kept calling me Lobo on stage and stuff, and Doug. But, that's classic Doug. So I just figured, you know what? I'm trying to be transparent anyway. I might as, if some people think my name is very 60s and hippie, whatever. It is what it is. I'm just going with it. But that's the source of potential confusion there. Just wanted to say, if you're thinking, isn't that Louis James? Yes, it is.
All right, we're putting you down.
Sorry, go ahead.
We're putting you down as AKA Louis James, so everyone will know who you are.
Very good. All right, to answer your question, it was actually a very simple thesis. Silver was oversold. And, I was very certain because we had seen similar behavior. I'm not Doug or Rick or one of these guys with many more decades. My most painful formative experience was 2008. And we saw that sell-off when the liquidity crunch hit. We saw the same thing repeat in March. And silver was way more oversold than gold. And we can get into why if you like, but just way more oversold. It was the better bargain. And so it's a very simple question. Are they going to rebound? Of course they are. Is silver still a monetary metal? Of course it is. And silver is the better bargain. So on that basis alone, it's very easy to get on board with silver, try to load up on silver stocks. But I also think there's going forward and looking at the specific situation right now with COVID, the shutdowns and all that. And I don't want to get into the medical issue. The shutdowns are the economic reality that's in the driver's seat now, driving Congress. And I think that is very important for silver bulls or silver anybody. You can be a silver skeptic, as you say. The significance is that we're not out of the woods yet. We can see, new shutdowns, possible second wave shutdowns, all kinds of economic harm potentially on the way. And that's going to impact silver differently than it will gold. Yes, it's still a monetary metal, but it's also an industrial metal. And we saw that aspect of it hit it harder in March. So if there's another March or even just a less drastic downturn, I can see silver getting whacked harder than gold. So that's one thing. The other thing is that reduced industrial demand shuts down mines. Copper mines are the #1 source of silver in the world. And most silver mines, as I'm sure your listeners know, aren't really silver mines. They're lead zinc mines or copper mines. Some of them are lucky enough to be gold mines with silver as a byproduct. But most silver mines have silver as a byproduct, and most of it comes from industrial metals. So if you have an industrial downturn, that's going to impact supply. So you could have this perfect storm situation where you have an oversold price again like March, you have supply actually going away because of the industrial downturn, and then you have the monetary metals rebound putting the squeeze on. So I'm not promising that. What I'm saying is that those cards are in the deck. I can see that in front of us. And if that comes together, you could really see silver blow the doors off of gold, at least in a percentage gain basis, which has been the story so far.
Hey, and when we look back in the good old days of 2011, gold hit its peak, silver hit its peak. And actually
Silver
gold hit. Yeah. And then we haven't seen anywhere near $50 silver, 49 and change since, but we see record gold prices, at least in nominal terms, and it's not too hard to envision silver following gold in this respect. And if gold keeps going, which it looks like it's a hair's breadth away from 2000 now,
yeah,
then I always liken it to the substitution effect, Lobo, of like, steak is now $20 a pound at the butcher supermarket, but chicken is only $3.50. So people load up on chicken and say, yeah, steak is good, but I could buy 4 times more chicken, 5 times more chicken than I can steak. And that's exactly here. You could buy many times more. It's still, 80 odd dollar, the gold to silver ratio, 80 to 1, 80 plus. What's your take on the gold to silver ratio? How important is it, or is it kind of meaningless except as a measuring stick?
I wouldn't say it's meaningless, and I get heat from people who really like the gold-silver ratio. My issue with is that I don't find it very predictive. It's significant. Obviously it means something if it goes way out of whack to 125 to 1, as we saw recently. What it doesn't tell you, though, is how the alligator jaws are going to shut. Right? It can close and come back closer to the mean by gold prices dropping, not just by silver prices rising. And over time, I've just never seen, I have never found the GSR to be predictive. It's more descriptive, if you follow me.
Yeah, exactly.
So that having been said, it does mean something. The March overextended. It's another way of saying what I was saying before about silver being the better bargain. Right. Yeah. So
couldn't agree more.
But that going back to what you were saying earlier, if you think about it, it's really quite interesting comparing, the rises since 2011, and the context is from the crash in 2008. So the rise in gold from the bottom in 2008, late 2008, to the peak in 2011 was about 180%. So where are we now? Gold is up from the March crash, 60%, something like that. If you're going to make a comparison of these two crashes and the follow-ons, gold has a long, long way to run. And of course, silver even more. So if gold is near its nominal, it's good that you point that out, nominal all-time highs. And by the way, neither today nor 2011 comes anywhere near the 1980 high in real terms. But we don't have to go there right now. Gold's back at its nominal highs. Silver has to double, not just, a nice increase, but, it has to double from where it's at now just to reach that same level of recovery. So, and that too fits a pattern, as you alluded to before. We've seen this time and time again. Silver lags, it's the laggard, but then on a percent basis, it tends to outperform gold. It tends to come zooming back, catch up, and it actually tends to peak before gold. So we haven't gotten that far in the conversation, but one potential takeaway here for the audience is if you're starting to wonder, well, okay, where's the top? We should expect silver to peak. It hasn't yet. And it should peak higher in a percent gain than gold. And that should happen before both of them go into reverse. So I'm not worried right now about gold having topped at all. And one reason is that silver hasn't given that signal yet.
Hey, and if we go back to 0809, that's when I bought the majority of my physical silver, somewhere between $7 and $9 an ounce, a little bit more higher than that, but not a lot. And when it crashed this time, I knew that it was going to go, it was going to go low, but that it would be very short lived, even shorter. Because remember, in 08, 09, it took a good amount of time. It took like 6 months or so to
Yeah.
get back to where it was. And the same with gold. Here, it took 6 weeks to get back.
Well,
And
actually, no. Wait, I got to push back on that. Gold actually closed 2008 in the black. Gold
right.
was the price of the metal itself is an extremely sharp V there, late November, early
Mm-hmm.
December, and by the end of December, gold ended the year positive.
Oh, okay.
The
So
gold stocks did take longer.
yeah, yeah, that's more what I was referring to. But you're right; it was a steep V, but silver took a bit longer, and silver was
And I think
literally
for the
on
same
sale.
reasons, right?
Yeah.
Same reasons now. Oh, it's an industrial metal, all that nonsense.
Hey, so let's talk about something near and dear to my heart because I love investment fads. I love investment trends, especially when they're completely divorced from economic reality, which so many of them are. But I'm talking about the Robin Hood effect, or what I would call the reverse Robin Hood. That's what they really should call that company because they're basically selling off all the data to the high frequency traders so that they can take money from the poor and give it to the rich. So, what effect, if any? Because I've heard there's been anecdotal evidence in zero hedge that Robin Hooders have all of a sudden or are starting to discover the world of massive profits in mining stocks because it's so easy to make money in this sector and everybody does it, right?
Yeah, well, I'm glad you asked because this is a thesis that I think I've actually been pretty early on. I wrote about it last year. And well, first I wrote about the idea that, or disputed the idea that many people have that young people are never going to be interested in gold, right? That, this drop gold campaign and all that silliness. I have to say that it's, I think, a huge misdirection of effort and energy, this conflict between gold bugs and Bitcoiners and so on. The real enemy is the U.S. dollar. Both, I just, just let's not hate each other. Let's look at the real enemy here, who's really taking purchasing power away from people, is all this inflation. So, but this question was, will young people ever get on board? And a lot of people saying, no, they're, it's an old man's thing, and so on. But I've been teaching economics and entrepreneurship in Eastern Europe for almost 20 years. And I have experienced how excited young people get when they realize that they can invest. And you start talking about different kinds of things. And sure, they're as interested in any rational opportunity as anybody else, including gold and silver and the stocks. I've seen this. So I was convinced this was possible. And I've been writing about it for some time. I've written some essays. But recently, there's the advent of this new website called Robin Track, which shows Robinhood, very simple, but Robinhood trends and how many users are in the stocks. And they make these very simple to read charts that show how many users are in, say, Tesla versus the price of Tesla. And you can see them both ramping up a nice FOMO
Yeah.
curve. And right now at independentspeculator.com, there's a new essay put out with some of these charts as an example. And we now have data, thanks to this, showing us that Robinhooders are, in fact, getting the message about gold and silver and even, believe it or not, uranium. So I think this is really important because it's one, it bucks the conventional wisdom that young people are never going to be interested in this. And two, it's probably longer than we want to get into right now, but I've seen signs of contrarian investing. I've seen signs of profit taking when, the reality comes to expect. And more recently, I've seen signs of the number of Robinhood users starting to rise faster than the share prices of, go-to bellwether names in the gold and silver space. So there are several ways we can go with this. One is it's a sign of momentum chasing. It's a sign of generalist investors. And these people are by definition generalists, right? They're not, silver-haired gold bugs who've been out in Idaho accumulating gold for decades. They're not old enough. So I think that's great. It's a sign of generalist investors coming in, and by definition, new investors, not people who've been there before. And it's accelerating. So that's the good news. The bad news, as with all generalist investors, they're not diehard gold bugs. They're not going to stick around if the trade turns the other way. They're momentum chasers, and they will go in and out with the momentum. So the Robin Hood effect here, when it's on our side, when FOMO is on our side, that's great. It adds extra oomph. But the flip side, though, is that we need to beware, when correction sets in, we could see greater volatility because of this. That same tide rushes in, it'll rush out. And personally, I think that'd be fantastic as a buyer, because I think it'll create better buying opportunities for everybody who's thinking, oh no, gold's record highs, I missed this buying opportunity. I think we could actually get handed some spectacular buying opportunities based on this rushing in and out on the next correction.
Yeah, I'm inclined to agree with you, and we see all the makings of it there. And yeah, the idea that the younger generations not interested in precious metals, they're maybe not as educated about them, but that can be changed very quickly. So as far as mining stocks go, I was looking at one thing you had about a life cycle of mining stocks, and you have this Golden Runway theorem, and I was wondering if you could share that with us.
Sure. The Golden Runway was a name the marketing guys came up with back in my Casey research days. This is research I originally did with them back in 2017. And the idea was to look at what has long been known in the industry as the pre-production sweet spot. You have this, the Lassonde curve is how it's known. It's a well-known curve you'll see in many exploration companies' presentations, where there's a line that goes up, it peaks in the exploration discovery, right? And then you go into the boring engineering or orphan phase, and then you ramp up to production, first pour, and then question mark, what happens next? You deplete that mine or you discover another one, nobody knows. And the insight here, it's not original to me, but as far as I know, I was the first one to quantify it. The insight is to ask, well, what is that increase from the boring engineering phase to first pour? And the conventional wisdom, and I talked to Doug and Rick Rule and my mentors back in the day, was that everybody could see who was building their first mine and it would be priced in. Yes, there was a transition there, hence pre-production sweet spot, but not a huge gain because it would be priced in advance. And what I found when we first did the numbers, it was so shocking. I sent my research guys back to find more data, do it again, and they came back with similar numbers. And I've now done iterations of this research 5 or 6 times. I have a sample of over 115 companies that are first-time mine builders, and the average gain from a construction decision to first pour is roughly 100%. They roughly double. Not all of them do. Many of them do much better. But that's a phenomenal gain for something that you can see happening, right? You don't have to guess who's building a mine. And in fact, in the data set, about 95% of the companies succeed. That actually means that 5% of them don't build their mines. So, it's not a guaranteed thing, but 95% odds on something that can double your money are, in my mind, as a speculator, that's incredible. We swing for the bleachers on long odds, hoping to get these 10 baggers. Something with such good odds on such a decent gain. Okay, it's not a 10 bagger, it's just a double, but great odds on just a double are fine in my book. So we do have a free report anybody can download if they want at independentspeculator.com. If you don't see it, type in PPSS in our search tool. That's for pre-production sweet spot. But there should be a banner there on our homepage. It's called The Greatest Discovery of My Career, PPSS. And you can share the numbers, the data, the latest research on that. It's an incredible finding that I am now putting to use in my portfolio. And I have now, if imitation is the greatest form of flattery, let's just say I have a lot of flatterers out there on this.
Hey, we all do. When you're first at something or you make a discovery, everybody's going to pile on. How many companies are there in that Golden Runway right now, approximately?
Just a couple, actually. So if you, on any given year, think about it. On a year basis, how many times do you hear about some company building its first mine? Like last year, a high-profile one would have been Lundin Gold with Fruta del Norte, right?
Right.
So in a given year, there's only a couple of them. And sorry, quick data point. That's interesting to me because if there's only a couple of them, my data goes back 30 years. I've got 115. That's a lot of them. I don't know how many there are in total. Some will have escaped my scouring. But let's say, if it's 30 years, if it's 5 per year, that'd be, that'd be 150 companies. It's, I've got a lot of that data. So I think the finding is quite robust. And one more thing I will say, when I first came out with this, some people said, well, why did you publish that? Now everybody can see it and everybody can do it. They don't need you. They can just go look for who's building their mine. And there are two answers. One is, honestly, I didn't think of it. I was really excited by the discovery and I published it. The other thing is, I think it would have been pretty obvious pretty soon if I keep buying all these people building their first mine, it wouldn't be long before people figured out what I was doing. The cat would have been out of the bag anyway.
Yeah.
That having been said, due diligence still matters. They don't all win. You can lose money doing this. The good news is that the overall pattern still works in a bear market. But due diligence still matters. And the real sweet spot within the sweet spot, and this is ongoing research I'm still working on, is there's a group within the overall group of really high performers. There's about half a dozen stocks that average around 700% gains between a construction decision and first pour. And trying to predict which ones those will be is something I have trials in place right now to do. So hopefully I haven't talked myself out of a job there. The idea is yours. You can have it. If you want extra help with the due diligence, you know where to find me.
All right. That's cool. Hey, so when these companies go up 100% or more, it doesn't it doesn't matter profitability or share structure or other factors, management. They just go up because the market's anticipating effectively they're going to be minting money, right?
I understand the question, and the answer is yes and no. As I said, they don't all go up. The double is an average figure, and some of them underperform. So if you got a blown out share structure, that's clearly an impediment. You got Australian scale of shares issued and outstanding, and you got a lot of people in at pennies. They're going to be selling on the way up, and that's going to be a drag. So those, like I was saying, due diligence still matters. But on average, you're right. Those things are like, I ran correlations between things like political risk and nothing. Size of deposit, nothing. Even like NPV and IRR, they had negative correlations on it, and it's very, very slight, but they were slightly negative. You'd think the higher the rate of return, the more excited people would be to get on board. But no, it really seems, this is hard to quantify, but it really seems that effective promotion is probably the #1 variable here. So, which reminds me, one of Doug Casey's famous 7 Ps, then 8 Ps, is promotion. And people, they say, oh, you promoter, like that's a bad thing. But a mining engineer is usually not the guy you want promoting the story. Effective promotion is good for shareholders. So I'm not saying it's all promotion. I'm saying that's a big part of it, because to your initial question, at first pour, or even when you start commercial production and declare commercial production, you have no idea at that point yet whether the mine's going to make any money. You're pouring gold. You're not saying you're making money. It might have cost you twice as much to pour that beautiful bar of gold that it cost than you make selling it. But the market is anticipating. The key here is you're going from spending money, literally pouring it into holes in the ground with a diamond drill rig, or construction equipment building mine. You're spending money and now you're making money. And clearly that transition from spending to making is worth a re-rate in the market. And the market anticipates it. Markets are forward-looking, right? So all of this fits with the normal way markets work. But you get the reward before you get the answer. And so part of the beauty of the whole PPS idea is that we have very clear entry and exit points. You can buy after the construction decision, and you can take profits or put a trailing stop loss on it when you get to the end point, and that way you can't get hurt. And if it turns out that they built a crappy mine, that's a technical term, or it doesn't make money for some other reason, or the commodity goes south on you, or whatever, they discover an endangered mosquito on the property, you get shut down, you can still lock in those gains. So I love this about this research, is that we don't actually have to know who's going to make money and have a great company going forward. I'm not trying to predict, the next Agnico Eagle or something. I have clear entry and exit points that help me lock in gains almost regardless of the outcome.
And that's called being in the right place at the right time. And,
Absolutely.
I'd always rather be lucky than smart, right?
That's what Doug Casey used to always tell me. When I first started, I'd bring him my research. I'm a bright-eyed young researcher, right? And I'd bring him all my math and my charts and my writing, and he'd say, "Oh, that's really smart, but this is what we're going to do." And he was always right. And that was his answer. Was I'd rather be lucky than smart. But really, what we're getting here is that was just his decades of experience, and what he sensed intuitively was something I couldn't capture in my formulas.
Yeah. Yeah, well, that's the expert system at work, the human expert system. So, besides the Golden Runway, obviously the mining sector is very, very volatile. As we've seen recently on the upside, what's the best way for an investor to play and capitalize on that volatility?
I don't want to over rely on my friend Doug here, but a famous Caseyism is also make volatility your friend. And we were just talking about the double-edged sword of the generalist investors, particularly these bright young bucks and Robinhood. So what I've learned is don't chase stocks. Don't don't be the one to top tick. Wait for volatility to be your friend. There's always a correction. And a lot of people don't want to hear this. As gold, I'll tell you, Kerry, quite honestly, when gold was at the 1800 stage, it only had about 2 weeks of consolidation there, which is very, very short in the pattern that we've seen for years in this space. And I was cautious. I was cautious that I thought it might correct more. And bang, it went right up to 1900. If I had been less cautious at that time, I would have made more money on the current rally. It's just a true fact I won't evade. On the other hand, who knows how it would have gone? If it had gone the other way, a lot of people that piled in would have lost a bunch and I wouldn't have, or at least not so much. So I'm making a case for caution here. I'm as excited as anybody. I'm as bullish as anybody. I firmly believe that $2,000 gold is an easy price target. $50 silver is an easy price target. I think actually $100 silver is an easy price target. And I believe there's potential for both to go much higher from there. But nothing goes up in a straight line. And okay, if I'm 19 on Robinhood, I got no kids, no dependents, and I live at home. I can bet all the money I have on gold going straight up. Fine, gamble. That's okay. But understand that you're gambling, right? Understand that you're chasing momentum there. And I think it's best to do, if you're even going to get on a momentum play, to do it with discipline. Don't throw caution to the winds. And there's always another opportunity. So I'm as excited as anybody. I do believe we're going higher. My bigger plan is actually to build cash right now. The stuff we were talking about earlier about the potential perfect storm for silver with more COVID shutdown corrections and possible meltdowns. I would hate to be all in if we get another opportunity like March or even better. And I absolutely think that card is in the deck in front of us.
Yeah, I think you are correct. It's a very good possibility because the future is always uncertain, as we get reminded over and over again. On the note of the Robinhooders, another $1,200 stimulus check is on its way shortly. They seem to have been able to agree on that much. The politicians, nobody ever didn't get reelected because they gave away too much money to their constituents. So, the joke in Zero Hedge is that they took their stimulus check and deposited into Robinhood, and they're off to the races. So that could bode well. And
I think there's anecdotal evidence for, there are people who've said I did that. So it's not just a supposition. There are actual cases. Now, statistically, how significant is that? I don't know. But I just want to say that that's not just people guessing. We actually know that's happening. We've seen people say that.
It makes for a good story for sure.
Yeah, it does.
And there's people who are doing it, and the Robin Hood effect is alive and well, and it might very well intensify. And we're just going to have to see where they go from here. As far as having cash to play with, to invest, should there be another pullback? If there is another pullback, you think the gold and silver are really going to get slammed along with the mining stocks? or is it going to be impervious to it?
Yeah, there's some debate about this, and I'm going to come down on the slam side. A lot of people are saying that the weaker hands were shaken out in March, were in much better shape. And to some degree, that may be true. Clearly, a lot of weak hands were shaken out in March. But it's also pretty clear, just from what we're saying right now, Kerry, the Robin Hooders, by definition, they are new money rushing into the space. And Robinhood does offer margin accounts, by the way. And there have been some very sad stories about people overextending themselves. So I think this idea that all the leverage was squeezed out of the system, not just Robinhood, but more general, that was all squeezed out in March, to the degree that that was true, I think a lot of that leverage is back on again. I mean, the risk-on attitude with the Fed's got our back, right?
Yeah.
Buy everything. Why not? The Fed's got our back. I think it's a very risky proposition to assume that gold and silver will not get backed in a general meltdown and another liquidity crunch. So I'm not going to make that bet. I'd rather pile up cash in advance. Now, this is actually an important point to clarify something. When we talk about this volatility and buying in these opportunities, I'm talking about the stocks, not the metals themselves. The metals are, in my view, they're physical wealth. They're the long for which there is no short. They're literally how I put my savings away. When I've got more money than I need for my needs or my investments, and I really want to sock away a bit more from my long-term savings, I buy bullion. And I never sell that. I don't trade that. I mean, I won't say never sell that. I don't trade that. I don't sell my bullion because gold has gone up or silver has gone, vertical or something like that. I just don't buy at that moment. I wait for the next dip to buy some more and continue accumulating. The only reason I dip into that is why anybody would for savings, right? I'm going to buy a house, or I've got an emergency and I need some money for, I don't know, kid's got a medical procedure or something. The same reasons anybody would dip into savings. I don't trade in gold and silver. Conceptually, I only accumulate as much as I can. The stocks are another matter. And, those are for seeking alpha. And I absolutely will look to make volatility my friend. I will take profits when I've made good money. Nobody goes broke taking profits.
Yeah, as Bernard Baruch said, and so many others since in different ways and forms. And of course, that's been many of you out there. And my downfall is not taking the profits when you have them. Talking about that briefly, because then we got to wrap up. The best one I ever heard is if the stock doubles, sell half of it. Now, sometimes you wind up not getting a lot of profits. You're missing out. You got the FOMO factor. But other times it ensures that you're getting out. And if the stock has tripled or quadrupled, God willing, then, sell off a little bit less than half, but take your money off the table. Does that strategy work for you, or you have a different take on it?
That was actually what Doug Casey taught me when I first came into this business. First double, sell half. You can sleep at night. You can't get hurt after that, whatever happens. But of course, the price for that is if it goes on to be a 10-bagger, your 10-bagger just turned into a 5-bagger. And a lot of readers I found over the years found that extremely painful. In fact, most people, you're a speculator. Back then it was the international speculator. Right now I publish something called the independent speculator. People know they're speculating. I don't get hate mail because a stock went down. But people get livid when a stock goes way up and I've taken profits too early, is what I found. You take this risk and you get a big win, and it's only half as much as it could have been. So I've modified the strategy. This is something else you can find at independentspeculator.com. There's a piece called Upside Maximizer. And the idea here is that instead of selling half on the first double, you put a trailing stop loss on it. Now it's not actually a stop loss at this point. It's actually a gain.
A sell stop, right?
So the idea is we don't know how high it's going to go. It's a double now, but maybe it is going to be a 10-bagger or more. So why sell half now? Well, to lock in. But you can lock it in with a stop loss. So once you get your first double, you put in a trailing stop loss and you just let it run. And if it goes to 200%, 300%, then you're triggered, fine. You can take your initial investment back if you're very bullish, or you can take the larger amount of profits back if you're scared about it, or half, or whatever you want. You don't have to sell everything, but you can sleep at night because you get your money back. And if it does then go on to become a 10-bagger, you have more upside than you would have had if you sold half on the first double.
Okay,
right?
so, but the
So
question is, how close do you put that trailing stop in there after
yeah,
it's doubled?
right. There
That's
are
my quandary.
well, there are services for people who don't want to do the math themselves. There are services like this, and I don't want to promote anybody because I don't know the principles well enough to vouch for their products. But there are subscription services for this. But I can tell you that basically you look at the volatility of the specific stock, and there are some that trade, but there's a pretty tight range. Say
Mhm.
10% for junior, right? 10% volatility on a daily basis is normal. So then you might set your trailing stop at, say, 1.5 times that, say 15%. So you don't really get risked of stopped out on a daily type fluctuation. Something would have happened different. Or if you're really bullish on that stock and you really don't want to get stopped out too early, you can make it 2x, right? So if it's 10% normally, set your stop at 20%. And that way you'll only get stopped out if something really big happens. Or if you really want to lock it in, you're really worried about losing money, you don't want it to slip through your fingers, you could set it at, say, 7.5, or just above 10%, 11% or something like that. Have a really tight one. It's up to you. The one size doesn't fit all. But the key point here is you look not at some sort of general one size fits all approach, but you look at the specific stock, its typical trading volatility, and set your stop accordingly so you don't get tripped out too easily.
All right. Well, that makes a lot of sense, and I am going to take a look at that myself. And of course, these stocks can go up and down so quickly. You can really get whipsawed. Anyways, just tell us again, Lobo, your website and where to connect with you on Twitter, etc.
Sure. Thank you for that. So the website is independentspeculator.com. There is an essay on the upside maximizer, the stop loss thing that we're talking about. You can find there. There's also a free report, very detailed report on the pre-production sweet spot there you can find. And there's a contact form. So if you can't find any of these things that we're talking about, just let me know. I'll send you the link. On
Cool.
Twitter, you can find me at Due Diligence Guy. I'm at Due Diligence Guy at Twitter. And I'm also on LinkedIn and Facebook. You may find me there under Lobo Tigre or Louis James.
All right, cool. Well, we really appreciate you coming on and educating us a bit here, Lobo. Really, it's great reconnecting with you. Any questions or comments for Lobo and myself? Let me know what you think about the trailing stop scenario versus the sell half and let the rest ride strategy. The email address is kl@kerrylutz.com, and our Twitter feed's at Kerry Lutz, Facebook page, Financial Survival Network, and of course our website, financialsurvivalnetwork.com. And Lobo, we will definitely talk to you again in the near future, and we'll see what the price of gold will be come the anniversary of closing of the gold window.
Yeah, I like that. I'll put that on my social media. Send me a link to your contest. That's fun. Thank you, Kerry. Thank you all. Have a great one.
We got it.